If you retire with $1 million, the most important question is not simply how much you have. The most important question is how that money turns into income. That is where most retirement mistakes begin. People spend 30 or 40 years saving, investing, watching account balances, tracking markets, and thinking about a number. Then one day the job stops, the paycheck stops, and the number has to become a system. That is a very different problem. Accumulating money and spending money are not the same skill. In accumulation, volatility can be your friend. A market decline gives you lower prices, you keep buying, you let time work, you let compounding do what compounding does. But in retirement, volatility changes character. A decline early in retirement is not just a temporary paper loss. It can become a withdrawal problem. If you are taking money out while the portfolio is down, you are selling assets at the wrong time. That can create damage that does not appear in a simple average return calculation. So when people ask, how much can I safely spend? I think they are really asking something deeper. They are asking, how much of my life can I fund without putting my future self at risk? And that question cannot be answered by one rule alone. Some people reach immediately for a withdrawal rate, 3%, 4%, 5%, maybe higher if they are comfortable with flexibility. Withdrawal rates are useful, but they are incomplete. They tell you how much you might pull from a portfolio. They do not fully tell you how secure the income feels. They do not tell you what happens emotionally when the market falls 25% in the first 5 years of retirement. They do not tell you what happens when one spouse lives much longer than expected. They do not tell you how much pressure your portfolio has to carry. That is why I want to look at retirement income as a system. A system has different parts. Social Security is one part, a portfolio is another part, a pension, if you have one, is another part. And for some people, guaranteed lifetime income through an annuity can also be one part. I know that word can make people uncomfortable, annuity. Some people hate them. Some people sell them badly. Some people buy them without understanding what they are giving up. Some people dismiss them without understanding what they solve. I do not think that is the right way to think. A tool is not good or bad in isolation. A tool is useful only in relation to the problem it is designed to solve. A hammer is a bad tool if you need a microscope. A microscope is a bad tool if you need to drive a nail. The same is true in retirement. A portfolio is flexible, liquid, and can grow. An annuity can create guaranteed income that continues as long as you live. Those are different functions. The question is not which one is morally better. The question is which structure fits the risk you are trying to manage. Let us begin with the classic retirement income framework. Imagine a married couple retires at age 65 with $1 million invested. Between the two of them, they receive Social Security. One spouse receives $2,500 a month. The other receives $1,250 a month together. That is $45,000 per year in guaranteed income. Now assume they want to spend $95,000 per year in retirement. That is their desired lifestyle. They subtract the $45,000 of Social Security from the $95,000 they want to spend. That leaves a $50,000 gap. That gap must be filled by the portfolio if they have $1 million invested and they withdraw $50,000 per year. That is a 5% withdrawal rate. A 5% withdrawal rate can be sustainable in many historical environments, especially if retirees are willing to be flexible. Flexibility matters because retirement spending is not usually a straight line. Many retirees spend more in the early active years, slow down in the middle years, and spend less later, except for healthcare or care-related shocks. But in this example, let us be more conservative. Let us assume the couple wants to spend the same real amount every year. No decline, no slowing down. They want that $50,000 portfolio withdrawal year after year. Because their portfolio has to fund a meaningful part of their retirement income, they may choose to invest somewhat conservatively. Let us assume they earn a 5.5% real rate of return. That means after inflation, this is important. Nominal returns can look high, but retirement is lived in purchasing power. The question is not simply how many dollars you have. The question is what those dollars can buy. If the portfolio earns 5.5% after inflation and the couple withdraws $50,000 each year, the portfolio can still grow because the return exceeds the withdrawal pressure. By age 70, the portfolio might be a little over $1 million. By age 80, it might be about $1.1 million. By age 90, it might be just under $1.3 million. Over 25 years, this couple may have withdrawn roughly $1.3 million from their portfolio and still ended with about $1.3 million. That is the attractive part of the traditional portfolio strategy. If markets cooperate, the portfolio can fund income and still preserve wealth. The couple starts with $1 million. They spend more than $1 million over time, and they may still have a large portfolio left for emergencies, later life needs, or heirs. That is powerful. but it depends on the market delivering returns in a reasonably helpful sequence. That is the quiet risk. A spreadsheet can show a 5.5% real return every year. Life does not work that way. Markets do not deliver smooth returns just because a retirement plan would be easier if they did. You may have a good average return over 25 years and still suffer if the bad returns happen early. That is sequence risk. And sequence risk is one of the central problems of retirement income planning. When you are 35 and investing, a market crash can be useful. When you are 68 and withdrawing, the same crash can be dangerous. That is why the structure of income matters. In the classic approach, Social Security gives the couple a guaranteed income floor of $45,000. The portfolio covers the rest. If markets are strong, the plan can look wonderful. If markets are weak early, the couple may have to cut spending, tolerate larger withdrawals from a smaller base, or accept more anxiety. Many people can live with that, some cannot. Some retirees are comfortable adjusting spending. They can travel less when markets are down, they can delay large purchases, they can reduce discretionary spending. Their plan has elasticity. Other retirees have expenses that are harder to adjust: housing, food, insurance, taxes, medical costs, family support, and basic lifestyle needs create a fixed floor. If the portfolio has to fund too much of that floor, the retiree can feel exposed. This is where guaranteed income enters the conversation, not as a magic solution, not as something everyone needs, but as a way to change the job of the portfolio. A portfolio can do many things. It can grow, it can provide liquidity, it can leave a legacy, it can fund variable spending, but it is not guaranteed lifetime income. An annuity is designed to solve a different problem. The type of annuity in this example is a single premium immediate fixed annuity, often called an SPIA. The basic structure is simple. You make one lump sum payment to an insurance company. In exchange, the insurance company promises to make regular payments to you, often starting very soon. Sometimes within a month or a quarter. The payment is based on several factors: your age, your gender, current interest rates, the payout option you choose. Once the contract is established, those payments are guaranteed by the insurer. The insurer takes on investment risk and longevity risk. That is the essence of the exchange. You give up control of a lump sum. You receive a stream of income that continues under the contract terms. The simplest version is life only. It pays income for as long as you live. When you die, payments stop. Because the insurance company does not have to guarantee anything to heirs, this option generally pays the highest monthly income. But that is also why many people dislike it. If you die early, the insurance company wins. Your heirs may receive nothing from that portion. Another option is life with period certain. This pays income for life but guarantees payments for a minimum number of years, such as 10 or 20. If you die before that period ends, payments continue to your beneficiaries for the remaining period. That gives more protection to heirs, but because the insurer has taken on an additional guarantee, the monthly payment is lower. Another option is life with return of premium or cash refund. This means that if you die before receiving at least the amount you originally paid into the annuity, the unused principal is returned to your beneficiaries. For example, if you put in $400,000 and receive only $150,000 before death, the remaining $250,000 would go to heirs. Again, this protection reduces the monthly payout. Nothing is free. Every guarantee has a cost. That is the first principle of annuities. You are always trading among income, liquidity, guarantees, and legacy. The payment level also depends heavily on interest rates. Insurance companies typically invest premiums in long-term bonds. When interest rates are higher, they can often support higher payouts. When interest rates are lower, payouts are usually lower. That is why annuity payouts have looked more attractive in higher rate environments. Age also matters. The older you are when you buy the annuity, the higher the payout tends to be because the insurer expects to make payments for fewer years. Gender matters because women tend to live longer, which often means lower monthly payments for the same premium. And every extra feature lowers the payment. Joint life coverage, period certain guarantees, refund provisions, inflation adjustments, these all change the expected cost to the insurer. Inflation protection deserves special attention. Some annuities can increase payments over time, but that usually reduces the starting payment meaningfully, sometimes by 15 to 30% or more. Many retirees choose a fixed annuity payment and rely on Social Security and the portfolio to handle inflation adjustments. That is a trade-off. A fixed payment gives higher starting income but loses purchasing power over time. An inflation-adjusted payment protects purchasing power better but starts lower. Again, there is no free lunch. There are only trade-offs. Now let us return to the same couple. They are both 65. They have $1 million saved. They receive the same Social Security income, $45,000 per year. They still want to spend $95,000 per year. This time, instead of relying entirely on the portfolio to fill the gap, they take $400,000 and buy an immediate annuity with a cash refund provision. That means the payments last for life, but if they die before receiving back the original $400,000, the remaining principal goes to heirs. Based on the kind of payout assumption in the example, this annuity pays about $2,300 per month. That is $27,600 per year. Now their income floor changes. Social Security gives them $45,000. The annuity gives them $27,600 together. They have $72,600 in guaranteed annual income. Their desired spending is $95,000, so the portfolio only needs to produce $22,400 per year. That is a very different retirement structure. They still have $600,000 invested after buying the annuity, but instead of withdrawing $50,000 from $1 million, they are withdrawing only $22,400 from $600,000. That is a much smaller withdrawal burden. And because so much of their spending is now covered by guaranteed income, they may feel comfortable investing the remaining portfolio more aggressively. In the example, assume that portfolio earns a 7% real return. This changes the dynamics each year. They withdraw $22,400. But the portfolio has room to compound because the withdrawal is modest relative to the expected growth rate. By age 70, the portfolio might be a little over $700,000. By age 80, it might be over $1 million. By age 90, it might be around $1.8 million. Now look at the whole system. The annuity pays $27,600 per year. Over 25 years, that totals $690,000 in income, since they paid $400,000 for it. By age 90, they have received $290,000 more than the original premium. Social Security provides roughly $1.1 million over that same 25-year period, and the portfolio may still grow to about $1.8 million while helping fund the spending gap. That is why guaranteed income can be powerful. It can reduce the pressure on the portfolio, and when pressure is reduced, the remaining portfolio may have a better chance to compound. This is the part many people miss. Adding an annuity does not necessarily mean you become less growth-oriented overall in some cases by creating a stronger income floor. You may be able to take more investment risk with the remaining assets because your essential income is covered that can allow the portfolio to play a different role. Instead of being the paycheck machine for everything, it becomes the growth engine, the inflation reserve, the legacy pool, and the source of flexible spending. That is a very different job. But again, the hybrid strategy is not automatically better. It solves some problems and creates others. The first trade-off is psychological. When people hold a portfolio, they often want to spend only the growth and preserve the principal. They like seeing the account balance. They like knowing the money is still there. They feel in control. An annuity asks you to think differently. You intentionally take a portion of savings and convert it into income. That part of the capital is no longer available in the same way. You have exchanged it for a contractual cash flow. Some people love that, some people hate it. Neither reaction is irrational. It depends on what risk bothers you more. If the risk of outliving your money terrifies you, guaranteed income may feel valuable. If the loss of control terrifies you, annuitizing money may feel unacceptable. The second trade-off is liquidity. A portfolio is liquid. You can access it, you can adjust it, you can rebalance it. You can sell some assets if you need a large amount of money. An annuity is not liquid in the same way. Once you annuitize, that lump sum is no longer sitting in your account. You cannot decide later that you want to withdraw it all for a house repair, medical bill, family need, or investment opportunity. You traded liquidity for certainty. That is the core exchange. If you do not have enough liquidity outside the annuity, this can become dangerous. Retirement always includes surprises, health expenses, family support, taxes, housing repairs, inflation shocks, and long-term care needs do not ask permission before they arrive. So if someone uses too much of the portfolio to buy guaranteed income and leaves themselves cash poor, they may have created a new problem. The third trade-off is inheritance. In the example, the couple chooses a refund provision, so heirs are protected if the annuity owner dies before receiving back the original premium. That softens the early death risk. But it is still not the same as keeping the full $400,000 invested. If the retiree dies early, heirs may receive less than they would have received if the money had remained invested and markets had performed well. On the other hand, if the retiree lives into their late 80s or 90s, the annuity can pay far more than the original premium. That is the purpose. Annuities are most valuable when longevity risk is real, and longevity risk is not abstract. The risk is not simply living a long time. Living a long time is usually a blessing. The financial risk is living a long time after your assets, your flexibility, or your spouse's support have been depleted. That is why guaranteed lifetime income can matter. It protects against the most expensive version of a good outcome, a long life. There is also the matter of inflation. In this example, the annuity payment is fixed. Social Security has inflation adjustments. Portfolio withdrawals can adjust if the portfolio supports it. But the annuity payment itself does not rise unless you buy a feature that increases it. This means the annuity is strongest in the early years and less powerful in real purchasing power later. That does not make it bad. It just means you must understand its role. If Social Security and the portfolio can handle inflation, a fixed annuity can still be useful. If the annuity is expected to cover expenses that rise sharply with inflation, a fixed payment may become less adequate over time. Again, the system matters. No income source should be judged alone. You need to look at how all the parts fit together. This is how I think about it. Social Security is a lifetime inflation, adjusted base. A portfolio is a flexible growth and liquidity engine. An annuity can be a contractual income floor. The stronger the floor, the less the portfolio has to support basic spending. The weaker the floor, the more pressure the portfolio carries. Neither is automatically right or wrong. The correct answer depends on the person. If a retiree has large Social Security benefits, a pension, low fixed expenses, and a high tolerance for market volatility, they may not need an annuity. If a retiree has no pension, high fixed expenses, anxiety about markets, a family history of longevity, and a desire for stable monthly income, an annuity may deserve a serious conversation. The error is not buying an annuity. The error is buying one without understanding the trade-off. The error is also refusing to consider one because you have heard a slogan. Slogans do not build retirement plans, systems do. Let us compare the two approaches more directly. In the traditional portfolio approach, the couple has $1 million invested. They receive $45,000 from Social Security and withdraw $50,000 from the portfolio to reach $95,000 of spending. They keep full control of the $1 million. They retain maximum liquidity. They have the potential to leave a large legacy. But the portfolio carries more responsibility. If markets perform well, everything may work beautifully. If markets perform poorly early, they may have to adjust spending or tolerate greater anxiety. In the hybrid approach, the couple uses $400,000 to buy lifetime income and keeps $600,000 invested. Social Security plus the annuity provides $72,600 of guaranteed income. The portfolio only needs to provide $22,400 per year. They give up liquidity and control on the annuitized portion. Their heirs may receive less if they die early, but they gain a stronger income floor, and the remaining portfolio may be able to compound more freely because withdrawals are smaller. So the question becomes this: do you value flexibility more or certainty more? Do you want maximum control or do you want more guaranteed monthly income? Do you want the highest possible legacy or do you want to reduce the risk of outliving your income? Do you trust yourself and the markets to manage withdrawals through bad cycles, or would a contractual floor make the rest of the plan easier to live with? These are not purely mathematical questions. They are life questions, and retirement planning always becomes life planning eventually. It is easy to argue in theory. It is harder when a real 68-year-old couple is watching markets fall and wondering if they should cancel a trip, delay a repair, or reduce gifts to grandchildren. That is why behavior matters. A retirement strategy that is mathematically optimal but emotionally impossible may fail in practice. If a person cannot stay invested during volatility, the theoretical return of the portfolio is irrelevant. If a person is so uncomfortable with annuities that they feel trapped and regretful, the guaranteed income may not bring peace. A good plan should be financially sound and behaviorally livable. That second part is often underestimated. Now, I want to be careful about the numbers. The examples assume specific returns: 5.5% real return for the more conservative portfolio and 7% real return for the more aggressive remaining portfolio. Real life will not move that smoothly. Markets can have long bad periods, inflation can be higher or lower, interest rates can change, annuity quotes can differ, health can change, spending can change, taxes can change, one spouse can die earlier than expected, the other can live much longer. This is why I do not think the goal is to prove one strategy wins in every scenario. The goal is to create a decision framework. A framework helps you ask better questions. How much guaranteed income do I already have? How much of my spending is essential? How much is discretionary? How flexible can I be in a bad market? How much liquidity do I need? How important is leaving money to heirs? How much longevity risk do I want to transfer? How much control am I willing to give up? How strong is the insurance company? What fees, commissions, surrender terms, or contract details exist? What happens if I die early? What happens if I live to 95? What happens if inflation is higher than expected? What happens if the market falls early in retirement? Those are the real questions. If you cannot answer them, you should not buy anything. Not an annuity, not a risky portfolio, not a complicated product. In financial decision, making, not understanding, is often the greatest risk. That is one of my core principles. Do not let complexity hide the real trade-off. An annuity is not magic. It is a contract. A portfolio is not magic. It is ownership exposed to market outcomes. Social Security is not magic. It is a government-backed income stream with its own political and inflation dynamics. The job is to combine these parts in a way that fits the risks you actually face. For many retirees, the traditional portfolio strategy works. Social Security covers a base. The portfolio fills the gap. Spending is adjusted when needed. The portfolio remains liquid and potentially leaves a legacy. This is simple, flexible, and often effective, but it can require emotional discipline for other retirees. A hybrid strategy can reduce stress. Social Security plus annuity income covers more of the desired spending. The portfolio is used for a smaller gap growth, inflation flexibility, and legacy. This can make retirement feel more secure, but it requires giving up control over part of the assets. The central principle is that retirement income is not just about maximizing expected wealth. It is about reducing the probability of unacceptable outcomes. For one person, the unacceptable outcome is dying with less money than they hope to leave to children. For another, the unacceptable outcome is living to 92 and being afraid to spend because the market is down. For another, the unacceptable outcome is losing liquidity. For another, it is relying too heavily on the market. People have different fears because people have different lives. That is why there is no one universal answer. But there is a universal process. First, define the spending need. In the example, it is $95,000 per year. Second, define the existing guaranteed income. In the example, Social Security is $45,000. Third, calculate the gap. In the traditional approach, the gap is $50,000. Fourth, decide whether the portfolio can reasonably carry that gap. That requires looking at withdrawal rate, asset allocation, market risk, flexibility, and time horizon. Fifth, consider whether adding another guaranteed income source improves the plan enough to justify the loss of liquidity. In the annuity example, $400,000 produces $27,600 per year. The guaranteed income floor rises to $72,600. The portfolio gap falls to $22,400. Sixth, compare the trade-offs. Less control, more certainty, less liquidity, more income floor, possibly less inheritance. If death comes early, more protection if life lasts long. Seventh, stress test. Do not ask only what happens if the average return occurs. Ask what happens if returns are bad early. Ask what happens if inflation is stubborn. Ask what happens if one spouse lives much longer. Ask what happens if health costs rise. Ask what happens if spending does not decline. A plan that works only in the average case is not strong enough. Retirement needs resilience. This is one of the biggest differences between accumulation and retirement. In accumulation, the objective is often growth. In retirement, the objective is sustainable spending with acceptable risk. Growth still matters, but resilience becomes central. This is where the idea of an income floor can be very useful. An income floor is the amount of spending covered by reliable income sources. Social Security is an income floor, a pension is an income floor, an annuity can be an income floor. The higher the floor, the less your basic lifestyle. Depends on selling assets in bad markets. That can make the rest of the portfolio easier to hold. A strong floor can also give psychological freedom. A retiree may be more willing to invest the remaining portfolio for growth if the monthly essentials are covered. That is what the hybrid example shows. The annuity does not replace the portfolio. It changes the portfolio's job, but the floor should not be built carelessly. If you spend too much of your assets buying income, you may weaken the portfolio too much. You may lose flexibility. You may reduce the ability to handle inflation, emergencies, or changing goals. The floor should be strong enough to reduce unacceptable risk, but not so large that it traps the retiree. That is the balance. And balance is the essence of good financial systems. When I study economies, markets, debt cycles, and human behavior, I see the same lesson repeatedly. Extremes create fragility. All growth and no safety creates fragility. All safety and no growth creates another kind of fragility. A retirement plan must hold both. It needs enough certainty to survive fear. It needs enough growth to survive time. It needs enough liquidity to survive surprises. And it needs enough structure to survive human emotion. That is the real problem. Most retirement conversations focus on products. I think they should begin with risks. Longevity risk, market risk, inflation risk, liquidity risk, behavioral risk, legacy risk, spousal risk, sequence risk. Every tool addresses some risks and creates others. A portfolio addresses growth and liquidity but exposes you to market and sequence risk. An annuity addresses longevity and income certainty but creates liquidity and control trade-offs. Social Security addresses lifetime income and inflation adjustment, but may not be enough. The right system depends on which risks matter most in your life. Let us make this even more practical. If a couple can live comfortably on Social Security plus a modest portfolio withdrawal, they may not need to annuitize anything. Their withdrawal rate may already be low. Their portfolio may have enough margin of safety. In that case, adding an annuity may reduce flexibility without solving a meaningful problem. If another couple needs a high withdrawal rate from the portfolio just to cover essential expenses, the plan may be more fragile. In that case, converting part of the portfolio into guaranteed income may reduce the risk of bad market timing and make the remaining assets more resilient. If someone has no desire to leave an inheritance and values lifetime spending confidence, an annuity may be more attractive. If someone has strong legacy goals, large liquidity needs, or a deep discomfort with losing control, they may prefer the portfolio approach. If someone has a pension, Social Security, and low spending needs, annuity value may be limited. If someone has no pension, uncertain longevity, and anxiety about withdrawals, annuity value may be higher. This is why context matters. The worst thing a retiree can do is copy someone else's answer without copying their facts. Your facts determine your structure. The example with $1 million is useful because it shows the mechanics. But your plan must begin with your own numbers, your Social Security, your spending, your taxes, your health, your spouse's needs, your desired legacy, your risk tolerance, your assets, your liabilities, your flexibility, your emotional reality. A retirement income plan is not a moral statement. It is a design problem. You are designing cash flows over an uncertain lifespan in an uncertain market environment. That is the system. And in any system, the weakest point matters most. If your weakest point is market anxiety, you need structure that reduces market dependence. If your weakest point is lack of liquidity, you need to protect access to assets. If your weakest point is overspending, you need rules. If your weakest point is fear of dying broke, you may need more guaranteed income. If your weakest point is fear of leaving nothing to heirs, you may need to preserve more assets. The answer changes when the risk changes. That is why I am not pro-annuity or anti-annuity. I am pro-understanding. I am pro-structure. I am pro-matching the tool to the risk. There are bad annuity sales. There are also bad portfolio plans. There are expensive products that should never have been sold. There are also retirees who kept everything invested, refused guaranteed income, panicked in a bear market, sold low, and damaged their retirement. The product is not the plan. The plan is the logic that explains why each product belongs there. If the logic is weak, the plan is weak. If the logic is strong, even a simple plan can work. Now let us return to the emotional side, because I think it is central. Retirement is one of the few times in life when people go from earning income to consuming savings. That transition can be psychologically difficult for decades. A paycheck arrives because you worked. Then suddenly the paycheck has to come from Social Security portfolio withdrawals and maybe guaranteed contracts. Many people do not like withdrawing from a portfolio. Even when the math says they can, it feels like watching the well go down. Guaranteed income can solve some of that feeling. A monthly payment that arrives no matter what the market does can create calm. Calm has value. It may not show up in a spreadsheet, but it can keep you from making bad decisions. At the same time, liquidity also creates calm for other people. Knowing the money is still in an account, accessible and under their control, can make them feel secure. That also has value. So do not ignore emotions, but do not let emotions run the plan alone. Use math to discipline emotion. Use emotion to test whether the math is livable. That is the balance. If the plan looks good but you cannot sleep at night, something is wrong. If the plan feels good but the numbers do not work, something is also wrong. You need both. That is why a framework is more valuable than a recommendation. The traditional portfolio strategy tells you this. Keep control, keep flexibility, accept market responsibility. The hybrid annuity strategy tells you this. Give up some control, create more guaranteed income, reduce portfolio pressure. Both can be rational. Both can be wrong if used in the wrong life. The $1 million decision is not really portfolio versus annuity. It is certainty versus flexibility. It is growth versus income floor. It is control versus contractual security. It is legacy potential versus longevity protection. Once you see that, the decision becomes clearer. You do not ask which pays more. You ask which creates the better retirement system for the risks I actually have. Because the strategy that pays more in a perfect market may not be the strategy that works better for a real person. And retirement is lived by real people, not spreadsheets. A couple with $1 million, $45,000 in Social Security, and a $95,000 spending goal has a $50,000 gap. They can fund it from the portfolio if markets cooperate and they stay flexible. The plan may work very well. That is the classic path. They can also move $400,000 into an immediate fixed annuity with a refund provision. That may add $27,600 of guaranteed income. Reduce the portfolio gap to $22,400 and allow the remaining $600,000 to compound with less withdrawal pressure. That is the hybrid path. The traditional path preserves liquidity. The hybrid path strengthens income. The traditional path may leave more flexibility and potentially more legacy. The hybrid path may reduce anxiety and longevity risk. The traditional path depends more on market returns. The hybrid path depends more on the insurer and the contract. Both require care. Both require understanding. Neither should be bought from fear. Neither should be rejected from prejudice. When I think about this decision, I come back to principles. First, do not rely on one number. A withdrawal rate is useful, but retirement income is bigger than a withdrawal rate. Second, build an income floor. Know how much of your essential spending is covered by guaranteed sources. Third, preserve flexibility. Do not annuitize so much that you cannot adapt. Fourth, protect growth. Inflation and long life require assets that can compound. Fifth, understand trade-offs. Certainty always costs something. Flexibility always carries risk. Sixth, stress test the plan. Good times do not reveal fragility. Bad times do. Seventh, make the plan livable. The best plan is not the one that looks smartest in a model. It is the one you can actually follow through. Uncertainty, that is the system. And if you understand that system, you can evaluate the decision more intelligently. You can ask whether your portfolio is carrying too much responsibility. You can ask whether an annuity would reduce pressure or create rigidity. You can ask whether your income floor is strong enough. You can ask whether your legacy goals are realistic. You can ask whether you are confusing dislike of a product with understanding of a risk. That is how you make better decisions. I have seen many people treat retirement as if it were only a math contest. It is not. It is a cash flow system under uncertainty. It is a psychological transition. It is a risk management problem. It is a family decision. And it is one of the few financial decisions where being slightly too aggressive or slightly too rigid can affect the rest of your life. So slow down. Do not ask only what pays more in a model. Ask what protects the life you want. Ask what gives you enough income. Ask what preserves enough control. Ask what lets you sleep. Ask what gives your spouse security. Ask what happens if you live longer than expected. Ask what happens if markets disappoint. Ask what happens if inflation stays higher. Ask what happens if you die early. A good retirement plan does not ignore these questions. It is built from them. That is why this $1 million decision matters so much. Not because everyone should buy an annuity, not because everyone should avoid one, but because the decision forces you to understand what retirement income really is. It is not just money. It is the conversion of assets into a life. And the structure of that conversion determines how much freedom, risk, anxiety, certainty, liquidity, and legacy you carry into the final decades of life. If you think clearly about that, you are already ahead of most people. Most people chase the answer before they define the problem. Do not do that. Define the problem first. Then choose the tool. That is the principle I would use. If your problem is growth and flexibility, the portfolio matters. If your problem is lifetime income certainty, guaranteed income may matter. If your problem is inflation, you need assets and income that can adjust. If your problem is liquidity, do not lock up too much money. If your problem is longevity, do not ignore income that lasts as long as you do. The right retirement income plan is the one that balances those forces in a way that fits your life. And once you see it that way, the debate becomes much less emotional. It stops being portfolio versus annuity. It becomes a system design question: what must be guaranteed? What can remain flexible? What should be invested for growth? What should be protected? What should be left for heirs? What should be spent for peace of mind? Those are the questions that matter, and if you answer them honestly, the right structure becomes much clearer. $1 million can be a powerful retirement asset, but it has to be organized. A pile of money is not a plan. A withdrawal rate is not a complete plan. A product is not a plan. A plan is a coordinated system of income, growth, liquidity, risk control, and human behavior. That is how I would think about it, because retirement is not about proving you chose the product that paid the most in hindsight. Retirement is about creating a structure that allows you to live with dignity, flexibility, security, and confidence through conditions you cannot fully predict. That is the real goal. And if an annuity helps some people achieve that, it deserves consideration. If a portfolio-only strategy helps others achieve that, it also deserves consideration. The answer is not universal. The principle is: build the strongest income system you can, understand every trade-off you make, and never forget that the goal of money is not just to grow. The goal is to support a life that can withstand uncertainty.